All right, so if you have any part of your portfolio that's invested in non-profitable high growth tech stocks, then you pretty much had a horrible 2021. There's just no bare bones about it. Let's just not beat around the bush. 2021 was a year to pretty much you kind of want to forget. And the way 2022 is looking, it's shaping up to be equally as bad, okay? So in this video, I'm going to discuss the likelihood of where non-profitable tech stocks could go within the short term. And also I'm going to explain why I like to invest in non-profitable tech stocks, because in bear markets, I've said this before, in bear markets, pessimists tend to sound smart, but just as history has always shown, it's the optimists that get rich. So right now we're getting a lot of pessimists coming out of the woodworks. You know, we're seeing a lot of bearish articles coming out left, right, and center. I'm seeing a lot of people in the comment section saying, oh, this is what you get for investing in non-profitable companies. But I'm a huge advocate for investing in small to mid to large cap, high growth, non-profitable tech stocks. And in this video, I will show you exactly why. So with that said, let's just dive into it. So what I have on the screen is the index for the non-profitable tech S&P 500 index. And as you can see, I mean, 2020 was a fantastic year. We pretty much ended 2020 with 1 month negative. So pretty much from January, February, all the way to December, we had profitable months. It was personally my best year in the markets to date. But as we flipped to 2021, you guys know the story. From February, pretty much from mid-February, you can see we only had 2 months that were positive, which was in June and which was also in October. So throughout the rest of the year, despite the S&P 500 making all-time highs, I think it hit like 67 all-time highs, the Dow Jones all-time highs, the Nasdaq all-time highs, and we all know that it was a handful of mega caps like Apple, Microsoft, Nvidia were solely responsible for that outperformance. But I mean, if you were in non-profitable high growth tech stocks, we got creamed, okay? We got creamed, no bare bones about it. And the start of 2022 hasn't been any different. You can see for January, I mean, this index itself is down minus 11% so far. So this is the bar chart information on a line chart, and the Financial Times did an article about this back in December. This was the pre-Roni highs here, and then we saw that dip, followed by a huge surge towards the upside. I mean, we went from 100 points to over 400 points within the space of 1 year, pretty much tripling up. It's insane, okay? There was a lot of euphoria. It was absolutely insane. And this article is trying to compare this period to the tech bubble, the dot-com crash. And they're now saying, are we in that crash? And as you can see, ever since the peak in February 2021, it's just been a slow bleed ever since, okay? And this article was from December. We were approaching this support level here at about 280. And I now have the updated chart. We've broken that support level at 280. We've broken support at 250, and we are now heading downwards, and we're now at the support where we were back in October 2020. So you have to remember, this rally right here was fueled predominantly by the Fed. Cheap access to capital. The market was extremely liquid. We had a huge surge of retail investors who really just wanted to be in high growth. A lot of this, you can argue, was pretty much very frothy. Now it's a completely different market. The cycle has shifted. We have seen a ton, okay? In my community alone, I've seen a ton of retail investors exit the market. They've cut their losses. They won't ever be touching the stock market again. They're out, okay? So the retail investor outflows in this current period far exceeds the inflows that we saw in 2020. Facts, okay? Look at all the data confirms that. So we're getting a lot of retail investors exiting the market in combination with access to easy capital. That's going away, okay? So we now know the Fed are a lot more hawkish. They plan to hike the rates, and all of the analysts and economists are saying that this is going to significantly reduce liquidity in the markets, and that's why we're starting to see this slow bleed. So the question is, if these theories prove out to be true, then the pain that we are experiencing right now in our portfolios, we're only halfway, okay? We're pretty much only halfway. If the theory is we are going back to pre-C-Roni levels, which was early February 2020, we're only at 230. So that will put us at about 180 before we can say, okay, we've returned to before this euphoric run. I think that's a realistic expectation. However, what does that mean for our portfolios? It means there's going to be a lot more bargains, a lot more deals, a lot more pain, a lot more blood in the streets. And that's just the reality. Okay. So in my mind, I'm preparing myself for more bloodshed. Okay. And I don't want to sound pessimistic. I just want to sound realistic. Okay. I want to be realistic with you guys. Like I said at the start, I'm an optimist. For me, these are incredible opportunities because I'm thinking 5-10 years out. So I will continue to own more of the companies that I believe will perform over the next 5 to 10 years, because ultimately the market is cyclical in nature, and eventually this irrational bearish sentiment will come to an end, and the companies that are growing their revenues, expanding operations, will survive and thrive. Okay. Now the question is, if we are headed back to the pre-Cerrone levels, what are we meant to do within that time period? And I think Jeremy from Financial Education, he did a fantastic video recently talking about the dot-com bubble crash, which pretty much lasted for about 2 years. So definitely give this video a watch if you haven't already. All you have to do is type in Jeremy Financial Education and it comes up. Subscribe to this guy. I watch all of his videos. I mean, he's been in the game for over 14 years. He's pretty much made his millions during periods like this. So it's one of the best ears to listen to on YouTube, in my opinion. Okay. And he was talking about the dot-com crash. And he said here, right, this crash itself was a 2-year period before it bottomed out in 2002. And then we started the recovery. Now, you've got two types of investors. You've got one investor who started buying maybe at the top. And let's say the market crashed, which it did, but they didn't have any more money to buy the dips and they were stuck at the top. It would have taken them 4 years, okay, 4 years in 2004 to finally get back to break even. Whereas if you're the type of investor that you were building up your cash pile and you were buying on the way down, then essentially you would have recovered much sooner than the person who bought at the top and didn't buy anymore. Your recovery would have been much sooner. Plus, by the time it gets back to the break-even point, you would have been a lot wealthier as well in the process, because essentially you have more shares, you have more ownership of these companies that are recovering, and in effect, you're growing your wealth. Okay, so this is not financial advice, of course. This is what Jeremy plans to do. This is what I plan to do, just to continue dollar cost average on the way down. The market is very cyclical in nature. Eventually, it will recover as long as the businesses continue to do well. And that way, our portfolios recover much quicker and we'll be much wealthier in the process. Now, why should you at all invest in companies that are unprofitable in the first place? I mean, this is one of the questions I do get in my YouTube comments. This is one of the criticisms I receive in the YouTube comments. I believe Jeff Bezos gave the perfect answer. Here's what he had to say.
Let's talk about profit, or in your case, the complete lack thereof. So let's just establish this once and for all. Can Amazon make money?
You have to understand, there are many ways of thinking about this, but the reality is that Amazon is a collection of several businesses and initiatives. And we have some very significant, very profitable, more established businesses that are free cash flow generating very significantly. And then fortunately, the way I think about it, we have lots of opportunities to invest in new initiatives, and we take advantage of those opportunities. So it's kind of like we built this lemonade stand, 20 years ago. The lemonade stand has become very profitable over time. But we also decided to use our skills and the assets that we've acquired over time to open a hamburger stand and a hot dog stand and so on and so on. So we're investing in new initiatives.
And this is certainly what your investors who've been with you for a long time fervently believe. And you ask them, like, why doesn't it bother you the way it bothers some people that the company's not profitable and has infinite PE and all this stuff?
Warren Buffett has this great quote. He says, you can hold a rock concert, and that's okay. And you can hold a ballet, and that's okay. Just don't hold a rock concert and advertise it as a ballet. Investors come in all shapes and sizes. They have different investment horizons, different approaches, different beliefs about what the right kind of portfolio looks like. And so it's not one, people use Wall Street as a shorthand, but there isn't one type of investor. They come in all shapes and sizes. And you have to be super clear about what kind of company you're trying to build.
I absolutely love this interview. I would suggest you give it a watch if you haven't already. But essentially, there are many different types of investors, okay? There's some investors that prefer to wait for the company to be profitable first before investing. There's some investors who prefer for the company to be profitable for a number of years before investing. There are some investors like myself who likes to invest in companies that are primarily focused on expansion, and profitability will come, okay? Jeff Bezos gave a perfect analogy of a lemon stand business. That lemonade stand did well, and then maybe you want to start opening up a orange juice stand or a banana shake stand. You know, he's expanding the empire. And, you know, when I look at the companies that I've invested in, companies like HIMS, for example, I've seen this company expand into different markets, from mental health to behavioral health to sexual health, and so many different categories. All the while, their subscriber growth is growing with each and every quarter. Their net orders are growing. Their online revenue is growing. You know, gross margins are being contained. Exactly the same thing with OPENDOOR, okay? They're purchasing a lot more houses. They're selling a lot more houses. They started in Q1 in 27 markets. By Q3, they were in 44 markets. These companies are expanding operations. And as a result, with the likes of OPENDOOR, we are seeing huge increases to the top line, which will eventually have an impact on the bottom line. And that's why I choose to invest in companies that are not yet profitable just yet, but are on the verge and also making the correct moves. Same thing with Tattooed Chef expanding into the likes of Target, Walmart, and so many other businesses that we reference on this channel. They're all within that stage, okay? So this style of investing fits my investment profile, okay? Jeff Bezos said it clearly. There's different types of investors with different time horizons, okay? I like to invest in businesses that are at the beginning stage of their S-curve, and then I can ride the wave of expansion as the company continues to execute. And that's my investing philosophy. It might not work for you, and that's absolutely fine. This is the way I choose to invest, and this fits my investment profile. So going into Q4, I plan to continue to track the businesses that I've invested in. You know, I've got a column here for Q4 results, the same thing with HIMS. And the plan is, once I see continued growth and the share price continues to tank, I get to own more of this company that is growing rapidly. I mean, go back to Amazon in the early 2000s when they were expanding. You know, a lot of investors sat on the sideline and that was their decision. But other investors who were a little bit more risk tolerant, you know, they saw Amazon expanding rapidly and they got in, right? They got in. And that's just the type of investor that I am, all right? So I hope you found this video very valuable. I'm not trying to scare you. I just want to be realistic. And I also want to explain why I decided to invest in these type of companies. It suits me, all right? So if you did gain any value, please make sure you smash the like button, hit the subscribe button and the notification bell if you want to stay up to date with all of my latest videos. If you want to join my Discord group, the Patreon link is in the description below. You can check us out if you would like. And with that said, I'll catch you in the next one. Peace.